Welcome once again to the November 2013 question paper. Today we are looking at question number 6.1, fixed assets. You are provided with details of fixed assets of Ulwas Limited. The financial year ends on 31 March 2013. 6.1.1, calculate the missing figures indicated by A, B, and C in the fixed asset note that is below. This is our fixed asset note. We have got A, B, and C. A is under land and buildings. B and C, they are under vehicles. Okay, so we need to look at the adjustments that are affecting our land and buildings and also our vehicles so that we can be able to do those calculations. Okay, the one that is given on number 2, it is saying unused land was sold for cash at a cost to solve cash flow problems. Okay, this property was bought by Pedoma Pty Limited. The majority shareholder in this company is Betty Benson, the CEO's wife. Okay, so when you look at the information under land and buildings here, in the column for land and buildings, you can see that the cost at the beginning is 300,000. The cost at the end is 2,100, 2,100,000, sorry. So to mean that, okay, fine, the cost decreased. What happened is because of this sale that took place. So to calculate A is not going to be a lot of work. So let's do the calculation for A. Then after that, we go to B and C. Okay, A, we are simply going to say the 3 million minus 2.1 million is going to give us 900,000. This is the answer for A. This one is just straightforward, okay? So A is supposed to be inserted there. Okay, A is supposed to be inserted here, 900,000. We are done with A. Now we are going to B and C. What is it that is on B? Is depreciation. And then C is accumulated depreciation. So we need to calculate the depreciation. Okay, so how do we calculate the depreciation? Let's look at the adjustment. There's adjustment number 4 and 5. A new vehicle costing 360,000 was purchased on 30 June 2012. And then number 5 is saying depreciation is written off on vehicles at 20% per annum on the diminishing balance method. So we are using the diminishing balance method to depreciate our vehicles. So what does that mean? Okay, let's do the calculation. B, the diminishing balance method. It means we are going to say cost minus accumulated depreciation to get the what? The carrying value. The moment you get the carrying value, multiply by 20%. Okay, so our cost, we'll go back to the question paper. The cost price is 780,000. The accumulated depreciation is 220,000. And even the carrying value is given, but we'll just show the calculation. All right, so it's cost 780,000 minus the carrying value minus the accumulated depreciation. The accumulated depreciation, which is 220,000, which is equal to 560,000, which is our carrying value. We multiply by 20%. Okay, by 20%, it will give us something like 112,000. So 112,000. So remember, okay, these are the old assets. Remember, there is a new asset. So the depreciation for the old asset, the asset that has been there in the business from the beginning of the year, is 112,000. Now we've got a new asset also. The new motor vehicle which was bought for 360,000 somewhere around June. So we're going to say 360,000 multiplied by 20%. Here there is no accumulated depreciation. Okay, there is no accumulated depreciation on a new asset. Okay, so we are not going to apply this formula. We are simply going to multiply by the rate of depreciation. And then we are also going to consider the time frame. When was this asset purchased? Let's go back to adjustment number 4. A new vehicle costing 300,000 was purchased on 30 June 2012. So from 30 June 2012 to 31 March 2013, how many months are there? There are about 9 months. Okay, so we're going to multiply by 9 months over 12, which is going to give us something like 54,000. Okay, so now we need to find out how much is the total depreciation for our vehicles. The total is 112 plus 54, which is going to give us 166,000. So 166,000 is the depreciation for the vehicles for this current year. So it is the one that is supposed to come at B, 166,000. Okay, so we are done with part B. Now we are moving on to part C. Part C, okay. Part C, they want us to calculate the accumulated depreciation at the end. The accumulated depreciation at the end, okay. How do we get the accumulated depreciation at the end? Simple. We simply say accumulated depreciation at beginning plus the depreciation for the year is going to give us the accumulated depreciation at the end. Okay, fine. So how much is the accumulated depreciation at the beginning? Is this 220,000. The depreciation for the year is this 166,000. Okay, so let's do that. 220,000. Okay, the accumulated depreciation at the beginning plus the 166,000 is going to give us 386,000, which is the accumulated depreciation at the end. So this is the amount that we are supposed to insert here, 386,000. Okay, so A, B, and C, we have already calculated the amounts. And if you look at the table now, let's look at the table. We have got A 900,000, B 166,000, C 386,000. So we are done with this question 6.1.1. Thank you.